We're excited to have you join us this week on Retiring Well. We have a great show mapped out for you, and we're going to start right in with the difference between pension plans and 401ks. Maybe you have one or the other, or maybe even both. It's important to know how they're different on the front end and on the back end. Then we're going to get into how to semi-retire. Maybe you're not ready just yet to take the full dive into retirement. Maybe you want to dip your toes in. This is a great information on that. Then we're going to talk about bonds versus stocks, and maybe not in the normal way. We're going to talk about the risk associated with each of them and how sometimes there's misconception on those ends. And finally, we're going to talk about financial jargon. Sometimes we hear the talking heads out there and the terms they use can leave us easily confused. What are some of these things and what do they mean to you? All of this and so much more coming up next here on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Let's talk a little bit about the difference between pension plans and 401ks. So retirement, as you may imagine, is all about your income versus expenses and seeing what that cash flow really looks like. And Social Security will typically replace maybe about 40% of your average earnings. So you have to figure out, okay, how are you going to make up the difference? Now, a pension is a defined benefit plan. So what that means is it's going to provide a predictable amount of income that you should be able to then rely on for the remainder of your lifetime. And it's going to be available for those that have maybe worked with an employer for a long number of years. There's going to be some type of minimum age requirement before you can start that. And so they're going to take into consideration the years that you've been employed, what your average earnings have looked like, and come to some type of calculation to determine what that pension would be. Now, employers are typically going to be the ones responsible to fund this pension plan. And in some cases, employees may also contribute, but it's primarily the employer's responsibility. And upon retirement, there's going to be some different options that you'll want to consider. The pension may offer you the opportunity to take a lump sum, where you might say, well, I'm not so sure I want to leave that fully in the hands of my employer for the remainder of my lifetime. I'd prefer to take that lump sum. Now, it doesn't, you don't have to take that as a lump sum and pay tax on it. You can roll that money typically over to an IRA account where then you have control, and then you can determine how much income you want to take, when you want to take that. If you're setting up, though, a normal pension plan where you're going to be taking these monthly income benefits, then if you're married, there may be a spousal type of survivorship option where if you choose to leave 50% or 75% or 100% of your pension if you pass away prior to your spouse, then there's going to be adjustments that are based on that information. So you may take a lower payout if you choose to do it that way. Now, a number of defined benefit plans really started going away. We saw back in the 90s, employers didn't necessarily want that responsibility of being responsible for those lifetime payments. So now you primarily will see that in different government types of positions. Meanwhile, 401k plans sort of shift the responsibility over to the employee. So employers may offer some type of matching opportunity. So if you're contributing, then they're going to match those contributions. And so again, it gets put in your hands to try and build up that plan. And you're contributing, and then you're able to invest however you desire, depending on your comfort level with risk. And so you can grow that and then choose to take that income however you want upon retirement. And that's where then sometimes you might get into the conversation of traditional 401k versus a Roth 401k. So your employer may offer that option. So again, traditional, you're going to get a little tax break for those contributions that you put in, but when you go to withdraw the money, it's going to be fully taxable. Whereas on the Roth side, you're not going to get any tax break for your contributions, but then when you go to withdraw that money upon retirement, then should be tax-free income for you. And the reality today is that 401ks are just more common than what we see than the pension plan. So that's more than likely the direction that you may be going, and it's something too where you might have the opportunity to do what's called an in-service rollover, where you're contributing to this retirement plan, but maybe you want more options or more flexibility. You could potentially roll that money over to a traditional IRA or a Roth IRA, or perhaps upon retirement, you want to explore other options, and so you look to transition that rollover to an IRA. So if you're in a position where you have questions about your pension plan and how that works and what's the best option for you, or if you're sitting in a 401k and not really sure what that next step looks like for you, we encourage you to give us a call here at Centennial Wealth Advisory for a no cost, no obligation second opinion.
As you are planning for retirement, where's your journey taking you? Do you know where you are going? How are you going to get there? And what's the best route to take? Do you have a personal retirement roadmap? At Centennial Wealth Advisory, we specialize in retirement planning, and we have designed a complimentary retirement roadmap video series that can be customized based on your personal circumstance and preferences. There is no cost and no obligation. Simply go to cen-wealth.com/roadmap and provide us with some basic information that will guide you to your on-demand, customized retirement roadmap video. Planning is the first step to succeeding. Plan to retire well.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Hey, welcome to this segment on 6 tips to successfully semi-retire. Hey, you might be sitting there feeling tired. You might be feeling stressed. You might be sick and tired of feeling tired and stressed. If that's you, maybe it's time to evaluate what your physical health is, what your mental health is, your spiritual health, maybe your financial health. Semi-retiring might give you that time to get the things that you care about most back in good order. So let's go through some tips that might be helpful as you evaluate if semi-retiring is in your future. The first thing is we need to make a plan. I love the quote from Benjamin Franklin. He said, if you fail to plan, then you are planning to fail. So as you're in your working years preparing for potential semi-retirement, I would ask a lot of questions. Can I afford to semi-retire? How long do I plan on semi-retiring? What does that look like? What is my budget going to look like? What do I want to do with those extra time? How can I reduce my stress, reduce my hours, and still feel like I'm producing, an entire career's worth of work and appreciating what you've learned? The next thing is to maybe reduce your financial footprint. This might be downsizing from a bigger house to a smaller house, or going to a condo. Or I love when retirees come in and they've been able to work off all those little debts and maybe even being debt-free with their house. And they were able to practice going into retirement by saving into their retirement plans and reducing their debt. That means the cash flow that they have coming to them is smaller, and then they get used to what a smaller income would look like potentially in that semi-retirement years. The next thing is understanding your healthcare costs. According to Fidelity Investments in Retirees' Healthcare Cost Estimate, if you are 65 and retiring in the year 2023, you on average will spend over $157,000 for the rest of your life in healthcare costs. You know, there's a misconception that just when you get to Medicare age that your healthcare is 100% free, and it's not, unfortunately. You know, you could be on the hook for dental, vision, maybe there's long-term care costs that are going to be in your future. So, you know, preparing for that and understanding what that cost would be. If you are retiring before 65, understanding that if you're losing your employer-sponsored healthcare plan, there are options out there, but there's going to be some different costs. And so just calculating that can give you some more sense of security as you make that decision. The next thing is maybe consider a bridge job. You know, this is something I highly encourage anybody that has spent a lifetime figuring stuff out through their work. You know, I heard it once that experience does not make you wiser, evaluated experience makes you wiser. And when I sit across the table from people that are close to retirement, the amount of wisdom that I get to steal from them is phenomenal. And what I see is that they've gathered a lot of evaluated experience. They have wisdom now. And where I think that is really helpful is a bridge job. Maybe they're going to go back and be a consultant. They're going to take everything that they've learned and pass it on to somebody else. They're going to control their hours. They're going to control who their boss is. You know, there's a lot of perks to that, and I've seen a lot of people be very successful at that. The next thing that we want to talk about is factoring taxes. Okay, when are you retiring? How old are you when you start that semi-retirement? Are you under 59 and a half? Are you older than 59 and a half? Those age are important to understand. Maybe you're under 55 or older than 55. That plays in when it comes to the type of retirement account that you might be pulling. Because at the end of the day, you want to try to avoid your 10% early withdrawal penalty. Okay, and so there are some different ages that you want to be aware of. So maybe you go into this consulting gig and you now are on a 1099 income. Well, now we have to talk about quarterly estimated taxes and understand how that job is going to fit into your overall long-term tax plan. And then finally, I would suggest just be flexible. Semi-retirement might be a nebulous time for you where you just get to sit at a different pace and you get to evaluate the things in your life that you care about most and have the time and energy to get them in good order. You know, semi-retirement isn't always about working less, it's about working differently. And so I would challenge you to map out what a semi-retirement might look like and take that extra time and margin in your life to say, here's what I need to accomplish in order to make my life and the time that I have in it look different. Thank you so much for watching. I hope that was valuable.
Retirement, something you've likely dreamed about for many years. Maybe you're approaching it here very soon or just recently retired. This is just for you then. Here at Centennial Wealth Advisory, we've created a retirement roadmap. Retirement is filled with many choices. What are you going to do with the grandkids? What trips you're going to go on? But first, we need to map out what this plan looks like. Where is the income going to come from? What investments is going to match up to produce that income? How are taxes going to look, and is there something that can be done to improve the situation today and for years down the road? Estate planning. What happens when you're gone and you're not here? What would you like to see happen with your assets and your estate and all of your loved ones that are left behind? Healthcare. You know, all the different options that exist out there and how different levels of income may dictate how much you're paying for your healthcare. Putting all those things together in a roadmap is a vital thing to retirement success. And not only that, but the confidence that you can go into that knowing you have a plan in place that allows you to enact all these dreams that you've had over the years. Simply go to our website at cen-wealth.com and there's an area to click on to sign up for this retirement roadmap. You'll get instant download and can watch it right away. And the beautiful thing is it asks just a couple questions and it hones it in and customizes it just for you and your particular situation. We hope that this video provides great value for you and again, gives you the confidence heading into your retirement so you can plan to retire well.
Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
Let's take a little bit of a deep dive into two very familiar, likely, investments that are out there that you commonly hear about, stocks and bonds. But today I want to talk specifically about the risk associated with them. You know, we like to think as investors that we want to have something with the least amount of risk possible, but the highest growth potential. We kind of want the best of both worlds. So I want to talk a little bit about stocks and bonds because sometimes I think there's some misunderstandings when we think of the risk associated with these various products. So first, stock. Well, what is a stock? Well, stock is basically a fractional ownership of a company. If you own a share of stock or multiple shares of stock, basically you are a little bit of an owner of that company. Whatever the stock you have voting rights through proxies and stuff like that. And then you have a share of earnings or depending upon what they're doing. So that value of that stock is determined really by the value of that company. Now obviously if it's traded on the open markets, there's some other influences that can determine the day-to-day value, but generally speaking, if you have a share of stock, it's some fractional ownership, so therefore it's a fractional value of what that company is worth. So the risk associated with stocks fall back to that company, right? So if the company was to go bankrupt, as an example, that's a risk to you because you're a partial owner, so your value likely would go to zero if it was a full bankruptcy. Systematic risk, as an example, kind of the old story, all ships rise and fall with the tide. So if maybe your company is doing okay, but maybe it's grouped into an area where they're struggling or something. Think of like 2008. A lot of stocks fell during that time period, right? That's kind of that systematic risk where a lot of things are falling at the same time and you get grouped into that. You know, inflationary pressures, depending upon what you're making, political pressures, did the government maybe change the regulations or something in the industry that your stock is in that then makes it harder to make an earning, or maybe they can't sell their product or some variation of it. So a lot of these different risks have associated with that stock. So now let's switch gears and talk about bonds. What is a bond? Well, basically, it's a debt. If you're giving money to a company or government or agency or something like that, you're basically loaning them money and they're giving you some interest rate in return for that. So that is an essence of a bond. It's a debt instrument. So what are the risks when it comes to bonds? Well, the company, the government, the agency that you're lending the money to, what if they go bankrupt? Well, there's a concern about that. Now, as a bondholder, you're in a better position than a stockholder and that sort of thing. But again, depending upon the assets of the company and stuff like that, you may or may not get your investment back originally. Interest rate risk. As interest rates change and you're in a stated or fixed interest rate, it could be an advantage to you or it could be a disadvantage. As simply as an example, if I buy a long-term bond and I'm getting, let's say, 2 or 3%, and then all of a sudden interest rates rise a little bit, and now a long-term bond I can get 4 or 5, well, I'm trapped in this 2 or 3% bond and I could get better somewhere else. So a little bit of an interest rate risk perspective from that, or reinvestment risk, they call it as well. When that bond matures, where is interest rates going to be at that point? So when you start looking at these two together, when we look at different risk and stuff associated with that, you have to ask yourself as an investor what risk you're comfortable with. Well, a lot of folks don't necessarily migrate to just one or the other. They look at both in conjunction and talk about like a diversified portfolio. And they start mixing these two together to try to mitigate some of the risks that maybe the other one has in an effort to try to make their portfolio more efficient and have the higher probability of returns. So again, when we look at just these two, there's so many more out there that you can be invested in, but just these two specific ones, we have those two characteristics of risk there. So nothing is risk-free per se when you look at those two specifically. There's some that get close, out there, and people will argue certain ways, but at the end of the day, there's risk associated with that, and you have to, as an investor, ask yourself what you're comfortable with. Make sure you know what you have as well. What portion do you have in stocks and bonds, and what specific ones do you have? If you don't know what you have or you're not sure, give us a call. We'd love to walk through, do a risk assessment with you, and help you determine those various layers of risk that you have. As we live in today's world with changing interest rates and other pressures out there, wouldn't you like to know what you have and feel more confident and comfortable with your retirement plan? We hope to help you plan to retire well.
At Centennial Wealth Advisory, we take a holistic approach to your retirement planning. So it's not just looking at what your investments are, but what is that long-term income plan for the next 30, 40 years of your retirement? What about taxes and what role they play in your retirement plan? Estate planning, what about life insurance, health insurance planning, all key areas to consider when looking at your retirement. So please visit our website or call the number on the screen. We'd love the opportunity to sit down with you for a no-cost, no-obligation visit.
If you like watching Retiring Well, make sure to go to youtube.com/retiringwell and click the subscribe button to never miss any of our TV shows and other informative videos.
It's your retirement. How will you live it? How will you be remembered?
Will you be able to take me on vacation? Will you be there for my ball games? Will you teach me your values? You'll be able to play with me. Will help me go to college. How will I remember you?
Have the retirement you dream about. Contact us today.
As you are planning for retirement, where's your journey taking you? Do you know where you are going? How are you going to get there? And what's the best route to take? Do you have a personal retirement roadmap? At Centennial Wealth Advisory, we specialize in retirement planning, and we have designed a complimentary retirement roadmap video series that can be customized based on your personal circumstance and preferences. There is no cost and no obligation. Simply go to cen-wealth.com/roadmap and provide us with some basic information that will guide you to your on-demand, customized retirement roadmap video. Planning is the first step to succeeding. Plan to retire well.
Investing is a broad topic, but it has very, very important implications on your life. So it's very important that you understand all the lingo or jargon involved in financial planning. So what I'd like to do today is kind of go over a few different confusing or uncommon terms in the financial world. Kind of brings me back to my early days in flight school here at NMC in Traverse City. They did an introductory flight to kind of make sure that you still wanted to be in flight school. They wanted to see if you really wanted to fly. And I remember sitting in that little Cessna plane next to the flight instructor, and he'd call the tower over the radio, and they said a whole bunch of stuff, numbers, abbreviations, all kinds of stuff that I had no idea what was going on. The one thing I did catch though was that you're cleared for takeoff, and that was all that really mattered at that point. But like flying, you need to know what's going on. You need to understand all these terms and lingo so you know where to go. So that control tower was telling us, hey, you got to take this runway or this taxiway to get to this runway, and the altimeter setting's this, the wind direction's that, and I had no idea. Well, financial planning and the financial world, there's lots of lingo that you need to understand as well. So some common terms or lingo that I see often are, okay, one question is, what is the difference between stocks and equities. And that's very simply, they're the same exact thing. So stocks, when you own a stock position, you own stock in a company. Well, that stock in that company is essentially equity in that company. So that term, stocks and equities, they're interchangeable, okay? The next one that I see very frequently confused is index funds versus mutual funds. So index funds are very simply investments that's tracking an indice. So a very common one is the S&P 500 index. So you invest in an index that's tracking that indice. Okay, now a mutual fund is more actively managed. Okay, the index fund is passively managed, the mutual fund is more actively managed. Now, when we have a mutual fund, obviously you can invest in various things according to your risk tolerance, but because it's actively managed, it's usually much more expensive for you. So there's going to be a higher fee with that mutual fund. Whereas the index fund, much more passive, you're just kind of riding the waves of whatever index you're tracking there. And the next one that's very important to understand is opportunity cost. Okay, so this is the cost that you're giving up by making one decision over another. So a prime example of this right now is with interest rates so high, a lot of people are thinking, okay, you know, I got this cash on the side, I should invest in these CDs. CDs are paying north of 4.5% right now. So it's a great investment. But what's another investment that you could put your money to work in and potentially get more return from that? Well, that would be your opportunity cost. Okay, so let's say that you put your money into an index fund that's tracking the S&P 500. Well, over the last 50 years, the S&P 500 has averaged just north of 10% annual rate of return. Now, would you get that guaranteed over this next year like you would a CD? Who knows, right? Definitely not guaranteed if you're talking about investing in the stock market. So that's your opportunity cost for picking that CD over another potential investment. And then finally, compound interest, okay? That's a big one, and it's so magical in the investing world. In fact, we got a slide here on the screen that I like to go over with you. And this is really what I like to show my younger clients as far as the starting early, the benefits of getting started investing right away. So in this scenario, we've got a client that's 25 years old. He's starting with $5,000 in his retirement portfolio, and he's investing $250 per month. If we invest over the next 35 years at that 7% average annual rate of return, you can see on this screen that he'd have north of $500,000 in his retirement plan when he retires at the age of 60. Now, what compound interest means is you're investing in some sort of investment, and those interest or the returns on that investment is reinvested and is growing as well. So when you have time on your side like this gentleman does, well, you got 35 years to grow those assets. He only put in $100,000, and yet his portfolio grew to over $500,000. So that's just the magic of compounding interest and something you want to be well aware of.